Hi, this is Michael Kolb, CFP with Evergreen Wealth Solutions, with your quick 3 to 5 minute update from our quarterly market summary. Unfortunately, all major indexes are down again, whether that's US stocks, large cap, small cap, international, emerging markets, they're all down about 25%. And in addition, bonds, which are typically a ballast to our portfolios, they're also down by about 15%. Why is that happening? Why are they both going down? The simple answer is inflation. There's still supply chain constraints. The Russia and Ukraine conflict is affecting oil prices. There's still residual effects from all the pandemic stimulus done in 2020 and 2021. And so the Fed is raising rates in order to try to fight that inflation. As they raise rates, those new bonds have better yields, and therefore the old bonds fall in prices. So all this attempt to try to cool down the economy and rein in that inflation, going from 0% to 3.25% in 9 months, has really hurt the bond market. And unfortunately, we expect those rates to probably get closer to 4 to 4.5% in the first half of next year. It's not great news for the bond portfolios. In fact, it's the worst year on record for bond portfolios. Luckily, we made a lot of changes to our portfolio back in fall of 2020 that really helped from a fixed income standpoint. But it still is down and it doesn't feel good. Speaking of feeling good, consumer sentiment is also at all-time lows, with about 1 in 5 consumers actually being bullish. That's one of the lowest times we have on record. So I don't want to be all negative, because there is some positive here. Why do we stay invested? Well, as I just mentioned, for the first time in 15 years, we're seeing bond markets that yields are topping 4% on treasuries and 5% on corporates. That's really, really attractive, and it's provided a lot of opportunity for fixed income. I'm finally having more conversations about fixed income than equities for the first time in a long time, and it's going to help clients who are taking income out of their portfolios going forward. In the full commentary, you can listen to Jim Dinsmore of our office reflect on his time leading clients through the 1981 problems, where the mortgage rates then were 15 or 16%, not the 7% that they are now. And one of the things he points out is that stock markets rose by about 5 times off the bottom of that. So it's not all doom and gloom. Valuations are still cheap. Labor markets are solid. Households are healthy. Earnings so far have held up. There are signs that some of the Fed's moves are paying off. Politically, we're probably going to have a divided government, which is actually a good thing for the market, as they're unlikely to get surprises. So there's a real mix here of both rosy and reasons for concern. So what does that mean for our indicators? Well, from an economic perspective, like we mentioned, we're still concerned. So we have about a 4 out of 10. Valuations, stock market and bond valuations, were actually really attractive right now. We're looking at a 7 out of 10. So they're not, peak attractiveness, but there's lots of opportunity for those investors who are willing to enter the market right now. Technically, we're looking at about a 5 out of 10, so right in the middle. What are we looking for going forward? Well, first and foremost, the number one thing we are looking for is the Fed to signal that they are slowing down or stopping on their rate increases. At that point in time, then the markets can actually predict and begin to normalize. We've actually had very, very low volumes for quite some time now, which means that any kind of market movement can be really volatile for the market, which is why you're seeing these big upswings and big downswings. The market's looking for direction, and until the Fed gives them that solid answer, probably going to continue to have that volatility. That might be for another month or another 6 months or another 9 months. I don't know, but it looks like we need to make sure that we're patient and we're ready for when the Fed does signal that that rebound is going to happen. Statistically, in history, when we've had Fed hiking cycles, the rebounds of the equity markets, once they stopped, have been very large and very swift. So it doesn't look great when we're down 25% in equities and 15% in bonds, and your whole portfolio is down, and it just feels awful. But we're in kind of a weeding game for the Fed right now. And what we're looking for is there is sunshine on the other side. It's stormy right now, but there is sunshine on the other side, and we need to be ready for that. We can't be in all cash, because those returns happen very, very quickly. And we can't just be sitting on the sideline and getting more aggressive when there's a lot of volatility as well. So what we're trying to do is be patient and prudent, find opportunities in different sectors of the market, and make sure that we're focusing on that financial plan, making sure that that probability of success is still really nice and high. And if it's not, talking to your advisor about what kind of adjustments you can make in order to make sure that you can continue to sleep at night, even when seas are really rough and stormy. So that's our quick market update for this quarter. We appreciate you, and we are grateful that you're our client. Thank you.